Well, welcome to the stealth gold bull market, the one that really shouldn't be happening. If you look at the old rules, there should not be a gold bull market today. There's positive real rates of interest. That should be a negative for gold. Gold should be down. The dollar is strong, solid at least. Gold should not be up. Rate cuts, well, at the start of the year, we were looking at between 6 and 8 rate cuts this year, according to market dynamics. Now it's down to 2 or less. Gold is up. Not supposed to happen. And if you look at COMEX contracts over the last month, actually down 36,000. Not supposed to happen in a rising gold market. This is a strange one, but there are reasons for it. And the number one is that this is no longer our commodity in the West. This is no longer a passive asset. Next slide, please. So the East is buying while the West sells. And the reason is very simple. The East is outbidding the West. They're paying more for gold. And if you look at the Shanghai-London gold premium, it rocketed in 2023, averaging $29 an ounce or 1.5%, the highest in history. And, actually hit $120 an ounce on September 14. So it pays for people to buy gold in London or New York and sell it in China. And that's what's going on. If you look at the gold tonnage versus the gold price on the left, that's GLD. GLD is on the way down. That's the black line. Its holdings have been diminishing for 2 years now, whereas the yellow line, gold price, goes up. This is very unusual. As you can see, historically, they usually track each other. And if you go to the right, bottom right, these are the ETFs for physical gold globally. Same story, even more. The white line is the ETF holdings going down sharply. The blue line, gold price. This is very unusual for a gold bull market. Next slide. And one of the reasons is that gold is becoming, once again, an oil currency. 20% of global oil trades in 2023 were done in non-dollar currencies, up from 0 in 2021. And as you can also see from the chart to the right, Swiss gold exports have increased to the Gulf Coast Council countries. Those are the oil exporters, by the most in 10 years. Oil is now being traded in gold rather than just dollars. Oil importers are using their currencies to buy oil with final settlement in universally accepted central bank gold. The leader in this area is Russia and China, who entered into a deal last year that started up on January 1 of this year. And there's significant quantities of oil going to China, and China is paying for those in yuan. Russia uses some of those yuan for Chinese goods and services, but they're taking back the excess in gold, trading those yuan back to the People's Bank of China for gold. So the oil price will now be another price driver for gold. This is new. And it's becoming an active asset, not just a passive reserve asset as gold used to be and as it still is in the West. The US has made the dollar as good as gold for oil in the 1970s. That was one of the great accomplishments of Dr. Kissinger, working with Sheikh Yamani, who was the Secretary General of OPEC and the Saudi oil minister. And they figured out that with the dollar off, the US dollar off gold, that the US would nonetheless make sure that it was as good as gold for oil, so that the oil exporters, principally the Saudis at the time, did not have to worry about the value that they got in exchange. That isn't working anymore. Next slide, please. Central banks are the biggest gold buyers. So the purchases in 2022 and 23 were at record levels. Massive buying is required nonetheless to get back to historic levels of 40%. It would take about $3.2 trillion of additional central bank purchases just to get back to where they used to be. And we think that's in the process of happening. Price insensitive buying has broken the old relationships, such as inverse correlation to real interest rates. Central banks don't care about real interest rates in the United States. So gold is actually replacing dollar denominated assets in central bank reserves. This is happening slowly. We don't expect to see the US dollar lose its hegemony in terms of its role in central bank reserves or its role as a trading currency globally. But there is another part of the world now that is not dollar denominated. And as that part grows, it's going to put additional pressure on the gold price. So you can see bottom right, this is the foreign central bank transitioning toward gold. The white line is the percentage of its reserves that are in treasuries, obviously on the way down. The blue is the gradual beginnings of a transition toward additional gold in central banks. And the chart above on the right, the World Gold Council estimates the lines in blue that tell you what actual purchases are occurring in central banks vis-a-vis the reported amounts in red. Next slide, please. So Western gold ownership is low and falling. It's quite extraordinary. Gold is now about half of 1% of investable assets versus about 2% historically. So it's never been that high, but it's certainly been much higher. There is no room for Western buyers to get into this market without an enormous price run. So this is a gold bull market with almost no participation from the West. Gold shares are near historic lows versus gold price. So that's where, the Western investor is going to get back into this gold bull market. You can see the upper right chart that, the shares versus the gold price have rarely been this low. It's near a record. It's unbelievable how the shares have collapsed against gold now with the gold bull market and Western investors looking for a chance to get in. We think this is going to take off. If you look below on the right, the asset allocation, 72% of advisors, or 71%, sorry, of advisors and asset managers have little to no exposure in gold, less than 1% of assets. And on the left, the chart there, you can see that, and this is now outdated, the way gold has been moving over the last month. But if you look at that number, you need to see at least an 85% increase in the share prices to begin to reflect what's happened to the gold price. Next slide, please. There's also stuff going on in the foreign exchange market that is going to end up, we think, very relevant to the gold price. And perhaps the most important is the yen carry trade, which we now see is coming to an end. Negative interest rates have encouraged Japanese investors to invest abroad and foreign investors to borrow in yen for investment in foreign markets, especially treasuries. There was obviously a huge difference in interest rate. Japanese portfolio investments, that's stocks and bonds, abroad, that is outside of Japan, equals 531.3 trillion yen, or about $3.54 trillion. The Bank of Japan implemented negative interest rates and yield curve control in 2015 to counter deflation and create inflation. They actually wanted inflation up. These policies, negative interest rates and yield curve control, have finally worked. Wage and price inflation are rising. Real rates are still very negative, however. So it is very likely that we're going to see ongoing rate hikes. They're now expected in Japan. Its policy was reversed, that is NERP and YCC, just last month. So we expect to see capital will flow to Japan. So we should see the yen up, dollar down, and more Fed support will be needed for the treasury market as Japanese money goes home. This is good for gold. In 2015, bringing in the negative interest rate policy dropped the yen 20%, popped the dollar, and helped make the gold market bottom of $1045 in 2015. Next slide, please. And one other thing to keep in mind, the sovereign debt doom loop that has been prognosticated for many years is finally here. David Hartnett, who's the CIO, Bank of America, predicts annualized Treasury interest expense will hit $1.6 trillion by the end of this year, becoming the largest single budget item. Fed rate hikes have driven the U.S. deficit and debt into hyperdrive, likely reaching Hartnett's prediction of $40 trillion by the end of next year. A higher deficit raises borrowings, increases interest expense, which increases borrowings. So this is why I think it deserves to be called a doom loop. And Treasury issuance is now mostly short duration, which is what you get in emerging market countries. And the interesting thing is that the shorter the duration, the more the securities are like cash. They're more like money. It's more like QE. Goldman Sachs, another thing to consider, predicts that 300 regional banks may go bust due to commercial real estate defaults and the Fed policy of staying higher for longer. If you look to the right, this is a chart by the National Business Economic Research Council, and it indicates that if you there's about $1 trillion worth of commercial real estate mortgaging and financing coming due this year, 2024. And across the bottom, you see the estimates or various possibilities of how much of that will go into default and the number of banks that will then become insolvent. So at about a 16% default rate on the mortgages and other financing vehicles, you get a 300 number in terms of bank insolvencies. This is serious stuff. And, I don't think it's been fully accounted for in thinking. What we'll see as a result is that the Fed will be forced to cut rates, probably more than anticipated at the moment, because they will need to reduce the pressure on the banking system, and the dollar will be sacrificed.